Howdy guys, welcome back to the Five Guys podcast. Today is Five Friday feedback. If you're watching this on Friday, this is where we recap Monday's episode while also doing a viewer mailbag at the end, a little bit of a win of the week as well, kind of hidden in there. But yeah, stick around. Yeah, it was going so well. But yeah, stick around for today's episode. It's going to be a good one as always, and we got a juicy viewer mailbag today, very juicy. So let's stick around for that as well. And yeah, with that being said, let's get right into it. Let's get into it, Chris. Howdy. Hi, Chris. Happy Friday. Welcome to the pod. How's your day going?
Thank you for welcoming me to my own podcast. That feels really good.
I'm Dom. He's Chris. Both co-hosts. It just be like that sometimes. So
We just be like that.
we got a good topic today.
We do. We're going to be talking about the mid-year financial checklist. We went over the 12 steps on Monday. So, and I really like our listeners to let us know, did you guys like the way that Monday pod went? We did talk a lot more about like philosophy and ways of thinking and stuff like that. I find ourselves getting a lot more sidetracked than we normally do on a Monday podcast. Typically, our Friday podcast is much more for us to get sidetracked and go down multiple rabbit holes. But if that's what you enjoy, please let us know, because I actually prefer those kind of conversations where we just kind of see what happens rather than trying to script everything out. Not that we ever script anything for the most part. We just have a rough guideline as to where we want to go.
Yeah, we're just
whatever happens.
Yep. Yeah, the only thing we're scripting is, maybe the intro a little bit, but really we've kind of gotten away from that. We don't do the scripting too much.
No, I felt because we were doing the scripting, I felt like we were just reading. And now it's just like, turn on the record button. Let's see what happens. We do it live.
Yeah.
So you don't know what we're going to say. I don't know what I'm going to say until I say it.
Yeah. Yeah, dude, he's just going. He's a man without anything. He says what he wants. He does what he is. Yeah. If that made no sense to you, I agree. Anyway, mid-year checklist. Very important. Chances are you haven't been doing them. This is your wake-up call. Yeah. So let's get into all of the rules, the checklist we talked about on Monday. It won't be, I think if you like a more sped up, condensed version, Friday is always your pod. Friday's your pod, guys. So yeah, let's get right into it. Let's do it.
Yeah. So first step, whenever we're doing the mid-year financial checklist, is first we want to go ahead and make sure that we review our spending. And obviously that's going to first mean that we have been tracking our spending. You and I here at the Five Guys, we are not big on budgets. I hate the B word. I think it's just a nasty word. We're not even going to say it. I don't say budget. Oh, there it was, and it hurt.
Hey, Chris.
See, I don't like that word, because when I have a budget, that means that I am projecting the future, saying this is what I want to happen. This is what I hope happens. And unfortunately, this is what never ends up happening. And then I end up just giving up on the budget altogether, because I projected I'm only going to spend $100 at the grocery store, and I realized 5 seconds in that was impossible, because I need both my milk and my eggs and my organic steak and whatever else it is that you think you need.
Yeah.
So what we do is we do a spending plan or spending tracking, where we see how much money we actually spent, and that gives us a chance to review every single month. How did I do spending wise? Did I use my money wisely? Did I not use my money wisely? Where, in what areas, what categories did I overspend, and in what categories did I underspend? What most people do is they passively go through life feeding the life that they don't want and hoping for the life that they have. Yeah, they feed the life they don't want and hope for the life that they don't have.
That they do want.
That they do want, that they don't have. And they're not going to have if they keep on feeding that wrong life.
Yeah. Yeah, that's a terrible conundrum to have. Yeah, we talked a lot about changing your small habits in order to make a big change. That is so key. Having a strong why. Being a little bit detail oriented, as well as, automating it with technology and whatnot. But okay, so that's a good point. So let's keep it going.
Yep. After that, we're going to go ahead and make sure that our income is on point to what we expected it to be. At the beginning of the year, hopefully if you're a W-2 employee, you're going to know what your salary is going to be. And you can project, for the most part, your bonuses. Maybe you expected to make, $100,000 this year, $60,000, $50,000, whatever it is. Go ahead. This is midway through the year. We're in July right now. Go ahead and see, hey, am I halfway to where I wanted to go? And if you're not, we're going to have to update our projections. I think the worst thing we could do is say, this year I'm planning on making $100,000. And by the time we're here, July, we're only at $25,000. But our entire budget, our entire financial plan, our entire everything was built around this $100,000 salary. And we're only a quarter of the way there, halfway through the year. Yeah. You think you're going to make up that other 75% in the last 6 months? I don't know. Maybe you have a big bonus coming. Maybe you counted on that. Maybe you didn't, though. So this is the time where we need to start assessing and saying, is my spending in line with the current projections I had for my income? Because those are the two sides of the equation.
Yeah. Yeah, absolutely. So the spending review, the income assessment. Did we talk a little bit about financial documents and keeping them organized?
I think so. I think that was
Did
step
we do
3.
Could it be?
Yeah,
Could I
so
be looking at the notes? Could I be? Maybe.
maybe.
Cheating a little bit.
So I think it's, that's important, right? We just went out, we looked at all of our spending, we looked at all of our income. Hopefully we have a bunch of financial documents out at that point. We're looking at stuff, or maybe we have a tracker that we've been doing all this for. You can automate this with Copilot, Monarch Money, Rocket Money if you like, for free. Whatever way you want to do it, I don't care. Just do it some way. After that, we want to organize our financial documents. We want to make sure that all of our important documents are in one place. The worst thing we could do is have 16 different bank accounts and 16 different statements, and to the point where we're like, oh, do I have an account at Wells Fargo, or was it Chase?
Yeah.
If you are confused, if something was to happen to you, I guarantee the person who has to pick up the pieces is going to be far more confused.
It's going to be an absolute crap fest.
Mm-hmm.
You die, and the person you've entrusted to run your estate, probably heartbroken, hopefully, and they're going to have to sift through all of that stuff. Keeping it organized makes life so much easier. How do you recommend that, Chris? Are we talking like digitizing it? Are we talking, what do you, a spreadsheet?
Yeah, yes, A and B. I would say first off, you want to have that spreadsheet. It's going to be so much easier to have a spreadsheet as to where all your money is, not just for your executive. If you don't want to think about death, just for yourself and your own peace of mind. It's got to be pretty tough to think I have 18 different bank accounts, each one of them with $100 in it.
Yeah.
Like that'd be really tough to think about. Why not just have one bank account with $1,800 in it? What are you really getting by having all those bank accounts, by complicating your financial life? Because maybe at one point you heard there's have 6 bank accounts. Well, millionaires also have multiple income streams, and you're not there yet. So why are you comparing yourself to someone that you're not there? There's that old adage, the average millionaire has 7 sources of income. Well, the average millionaire is also in their mid-50s, and you might only be in your 20s or 18 years old.
Mm-hmm.
And now you're going to end up trying to chase 6 rabbits. And if you ever try to chase 6 rabbits, you're going to realize that you're not going to catch any of the rabbits. You have to focus on one, get good at that, then move on to the next one.
Absolutely. It goes back to what, honestly, we should do like a podcast of the pillars of failure. 50 years old, 7 income streams, 6 bank accounts, right? You, 18, poor, 1 job. Don't compare them to you. They were not rich at 18, usually. You can strive for that goal, but look at the steps they took, not the destination they're at. Yep. I think that's the key thing as well, is reframing.
Also, remember that they're in a different world. You're in a different world than they were.
Yeah,
so
sure.
Even if you did the exact same steps as Mark Zuckerberg, Elon Musk,
mm-hmm.
Bezos, you did the exact same steps, you're probably still going to fail because they were in a different world than you are now. And that's an interesting thing. So please stick around for a future podcast. We're actually going to do the 10 commandments of business failure, because it's very hard for me to tell you what's going to get you to be able to succeed in business. But I can tell you that if you do these 10 things, you will fail. So rather than focusing on what has to go right, I'm just going to tell you what you have to do wrong to fail, so you know what to avoid.
Absolutely. Yeah.
So
no, I'm excited for that podcast. Yeah.
You can always invert. Same thing for your fitness. Hey, if I want to be fit, I want to get swole for the summer. I don't know what steps to do. I know what steps not to do. I know to not just sit around all day eating Cheetos. I know to not move my body. I know to not get good sleep. So what I'm going to do is I'm going to do the opposite of those. I'm going to try to eat real food. I'm going to try to exercise, and I'm going to try to get good sleep. That's going to get you a good amount of the way of where you're trying to go. Same thing with your finances.
Yeah, absolutely. Absolutely. And if we're doing a 6-month review, we got to talk about savings, right? Mm-hmm. That's got to be a part of it. Evaluating your emergency fund, the 3 to 6 months. Some people, I know Chris, he likes to run 12 months. Nothing wrong with that. It's all about peace of mind, What else, Chris? I mean, what am I missing? High yield savings account, keeping
Yeah,
savings.
high yield savings account, money market account. I think the big thing is when you have your savings account, if you tell me, oh yeah, my savings account, it's in Bitcoin. Well, then you don't have a savings account. That's not an emergency fund. Your emergency fund is not something that should be volatile. It should be something that is consistent. And yes, you are going to be losing out to inflation.
Mhm.
Yes, you're not financially optimized when you have a emergency fund. Having cash on hand is like having air to breathe. You don't think about it until you don't have it.
Yeah. Gosh, isn't that the truth? That is the truth right there. Yeah. It's an emergency fund has to be liquid too.
Yep.
I don't know how fast you can get out your investments, right? That are quite volatile. It might be down right now and you don't want to sell them because they're going to go up, allegedly.
I've met a guy who said, oh yeah, my emergency fund is my rental property that I have. So you're saying that shit hits the fan, you lose your job, you need to bring money, you're going to need to get rid of a tenant who is most likely in a contract and then sell the house to get the money in the next like 24 hours or 48 hours or whatever. Obviously, we can always put things on credit, run it for 30 days and then go ahead and pay it off. But you're telling me you're going to sell a house and everything in 30 days? I don't think so.
Or even refinancing it. That takes time too.
Even that's not an emergency savings. Like if you're counting on, I'll just refinance my house in order to come up with any issue, to deal with any issue that comes up financially. Again, we're in a bad situation. And the reason that we do the savings review as step number 4 is because this is also a good time to check based off of our spending assessment, how much are we actually spending? If I think I spend $1,000 a month, but I see that I'm actually spending $5,000 a month, and I have quote unquote 6 months of savings, which is $6,000. Well, you don't really have 6 months of savings. You have basically 1 month of savings. So you're going to need to increase that, or you're going to be taking on more risk. And the risk that we have when we have these emergency fund is what happens if I lose my job? What happens if I get hurt? What happens if I need money and I can't work? This 3 to 6 months, maybe a year, whatever it is for you, I recommend 3 at the minimum, is what's going to get you through those hard times so that you don't end up in a bad financial situation that you're going to spend the rest of your life trying to get out of. Because the leading issue for people losing money has nothing to do with being bad at their job, getting fired. It has to do with injury. They get injured and they can't work anymore. And no matter how safe you are, it can come at any time. You can be driving to work, you can be walking on the curb and get hit by a car. And now your source of income is gone. That is where that emergency fund will come in to help you and save your life.
Yeah.
Both literally and figuratively.
Simple as that. Honestly, it really is as simple as that. You got to be careful with that stuff. You can get caught real fast, and it gets scary real fast. So
remember, the leading form of bankruptcy in America is medical debt. And most people go into medical debt not because they don't have good insurance or they're underinsured or even they're uninsured. It's because they had the audacity to get sick in the first place. Something that we don't always have control over. And I would say we very rarely have control over.
It's really funny. They have the audacity to get sick. How dare they? I was reading a study that says death itself could be cured through cold plunge. Check that out.
Check it out.
Check that out, bro science.
Hashtag bro science. Hashtag always works. Hashtag don't check the science.
Don't look into it. Just believe.
Just believe.
But your life might be better at the end of the cold plunge. I can't guarantee eternity. I won't. I shan't. It's not even funny to joke about. Number 5, debt management.
Debt management.
I
think we're going to be diving into the bag of the things we don't want to look at. We're going to be looking at all of our outstanding debts, whether that be credit card debt, car loans, mortgage loans, student loans. We're going to want to balance all those things out. Look at every single one of them. And I know it's scary. I get it's scary. But the longer that you avoid it and pretend it is not there, the bigger that monster grows. So once we have all that stuff laid out, again, we should already have it because we've already organized our financial documents, right? Indeed. All this stuff kind of feeds into each other. We have it all in front of us. Now we're going to go ahead and organize, check the balances, check the interest rates, check the monthly payments. This is the time to develop and update your repayment plan. Hopefully we have a repayment plan. Are we doing the avalanche method? Are we doing the snowball method? Are we doing the hybrid method? Or are we just doing the spray and pray approach? We're just doing minimum payments on everything and hoping that if it goes away long enough, I'll figure it out.
Yeah. It's not ideal.
Too many times, Dominic, have I met with people who
Mhm.
are in debt. And the more we go down the rabbit hole, the more that I find that people get into debt for a number of different reasons. But the reason they don't get out of it is because they think someone is coming to save them. And the reason they think
Mm.
that is because they have actually been correct. I've had a person recently who was $100,000 in debt, and then their grandma passed away and ended up leaving them $80,000. They used that $80,000 to wipe out the debt. Then they ended up getting themselves back into debt, and then their parent ended up taking out a loan and gave them money to pay off the debt again. So I ended up having to come to the conclusion of asking her, is this a problem you really want to fix? Because you've never, is this even a problem for you? Because what you've learned is that someone's always going to come to save you. And as long as someone comes to save you, then yeah, it all works out well and good. But at some point, you have to take responsibility for your own life. And at some point, someone might not show up and you have to be your own hero.
Dude, that's so sad. Wow. An inheritance is not meant for debt relief, in my eyes.
But how many of us, how many people
I
go through
know.
life saying, oh, well, it's okay. My grandma has a trust. She's going to leave me all this money. I don't have to save for my retirement. Well, most people that end up dying who have trust, their trust has no money in it because when you die, I'm not sure if you know this, it's extremely expensive to go into hospice care, to go into all these things. Most people aren't just, you don't just wake up dead. No one's just dying. No one's like, oh man, I saw him yesterday. He was totally fine. Now he's dead. That doesn't happen very often. I hope that happens. I hope that happens to me, but that's not normally not what happens. Normally, there are years and years of suffering or months of suffering where we are exhausting all of our money to try to stay alive. And unfortunately, I've met people who said, oh, I thought I was going to get this inheritance. And it never came because after grandma died or mom and dad died or whatever, there was actually no more money left in the trust, or there was no more money, or God forbid, there was only debt left. And now I had to deal with that. Obviously, it's not going to pass to you. That's not how debt works, but it's still a nuanced conversation that we have to realize that we're the only person in control of our life. We are the hero to our own story.
I thought you were going to say, God forbid, grandma bet it all on black and lost it all at the casinos or something like that. Like, oh, no. Hospice care. Very expensive. I was like, oh,
Hey,
it
who knows?
is.
That's
It's the
also
reality.
that's also very common though, is that older people get scammed. Grandma and grandpa was like, hey, I'm going to leave you all this money. Someone calls up saying, hey, yeah, I know you want to leave this money to your grandkids. How about you send me that? And I'm going to double it. And now they lost all of it.
Double it and give it to the next person. Yeah,
Don't leave it to the next person.
is
These
the
things
next one
legitimately happen.
Sunny? It's like, no, it's not. Stop scamming.
Like, these things happen, and they're getting worse now with the advent of AI, the advent of things like 11 Labs. You're able to now go on someone's Facebook feed, go on something's everything, get their name, get their number, get grandma's number, and then you can call as the grandkid, Grandma, I'm in trouble, and actually have the voice of the person.
Yeah.
Me and
we're
my parents,
finished.
my parents have a safe word. That's how crazy this has gotten. Me and my parents, because there are hundreds of hours of us talking on the internet. Me and my parents
Really?
have a safe word. Yeah. Hell yeah.
Yeah, well, you had
How
a
many-
podcast? What happened? Hundreds
know,
of
right?
hours.
Fine, 100 hours.
Okay, 100 hours.
There's
I
100
know.
hours of us. And how much do you have on your Twitch stream?
Thousands. And we're about to come up on the 500th stream, and each stream is roughly 2 hours.
So I would recommend that you and your dad, mom, anyone that's important to you, come up with a safe word that if someone ever calls saying, hey, it's Dominic, I need these things, your parents could say, hey, what's the safe word? And then you can say whatever it is, whether that be mongoose or sassafras or donkey. I don't know. Whatever it is, you should come up with a word, because you don't want your parents to ever be like, oh, is Dominic actually in trouble?
Yeah. Or I'd be like, tell me something so intricate, so embarrassing that I would never speak of. Be like, when you were 5 years old, and it's like, oh God, don't tell me that. Okay.
It's easier to come up with a code word, but whatever you want to do, you want to do that way, you can do that. But this is the world we're moving into, and you can't always count on the inheritance. You can't always count that someone's going to come to save you. Step number 6: after we do the debt management, after we come up with a repayment plan, after we update everything, we want to optimize our subscriptions. This is a very good time once a year to review all of your reoccurring expenses and decide if these subscriptions are essential or if you can cancel them. Maybe you open something just to watch one series. Now you finish that series. Can we get rid of it?
Yeah.
I understand that it might only be $15 a month, but that $15 a month does add up, especially if you're not using it.
Yeah. Yeah. Honestly, like I had a subscription from the Super Bowl. I didn't have cable, so I was like, I'm gonna watch it on Paramount, and I got it, and then I forgot about it for like a month. And I was like, oh dang, I gotta cancel it. Cancel it.
Yeah.
Happens
I
to the
had
best of us.
I had Hulu. I have pretty much all of them. Like I have a bunch of them, but I have Hulu that I was paying for, and then I realized, oh, one of my credit cards actually gives me free Hulu. So if I put it on that credit card, it reimburses me the full cost.
Oh, that's nice.
So now I get free Hulu because I went back and I looked at all my subscriptions and I made the realization, oh, this credit card giving me free Hulu, and I'm not using it for this account.
Yeah,
now I
that's
just put
nice.
$16 back into my pocket. I just made $16 by going in and changing my credit card information.
There you go. There you go. That's not bad. That is not bad at all.
And it's building me more points to go on more travel.
I was a professional hacker. I say it all the time. He's a credit card hacker. He is. Dangerous man. Watch out for him. So the next one.
Number 7, we're going to consolidate and simplify our accounts. This one is a big one. The most difficult thing that people do in order to try to be good with finances that ends up screwing them up is overcomplicating things because they think in order to be good with finance, I have to have a complicated situation. When you very rarely, if ever, have to have a complicated situation in order to be good with finance.
Yeah.
Simplicity is key. The enemy of progress is complexity.
There you go. It really is. I mean, it doesn't get much simpler than that. The simplicity.
So, consider one bank account, one spending tracker. Maybe if you have too many credit cards and you can't handle it, cut the rest of them up and get one credit card.
Yeah.
I have like 16 credit cards. But again, I've been doing this for a decade now. Yeah. I don't recommend that someone open up 16 credit cards to get into the travel hacking game. You start with one card and then you build up as you get better.
Yeah.
Absolutely. Next thing we want to do is automate bill pay. And I know that this is something that seems silly. Chris, you want me to go and spend like 20 minutes doing all this silly things? Like, this is my mid-year financial checklist. I need to know the secrets, man. Well, every time that you go and you set up this automatic bill pay, you just save yourself 5 minutes a month. That 5 minutes a month saves you an hour over a year. And that hour is going to give you an hour back of your life for the rest of your life. If you're 20, that's a full day if you live for 24 more years that you have back, that you're never going to have to do anything when it comes to bill pay. It also protects you from maybe getting injured or maybe just forgetting. How many times are we going like, oh, on the first, I'm just going to go and make the bill payment or whatever. That's another thing. That's another part of mental bandwidth that is now being used up for something that is 100% unnecessary to be used up. Get rid of that shit. Set up automatic bill pay. Avoid late fees. Improve your credit score. Ensure timely payments.
Yeah, absolutely. It's super simple. It's great. Yep. Great tip. Number 9.
I always recommend going ahead and setting it for statement balance or current balance. Don't set it for minimum payment because you never want to get into the situation that you're just making minimum payments on your credit cards. Yeah. If you're in the situation where we're making minimum payments for our credit cards, we have made a mistake a long, long time ago. We need to correct right now. Yeah. And hopefully you've already discovered that before we even got to this step.
Yeah, absolutely. Talking about credit health.
Step number 9.
We're talking about credit health now. Might as well. We're talking about credit cards, so might as well get into that. So you recommend pulling your credit once a year from the big 3, Equifax, Experian, and TransUnion?
Experian, yes.
Experian. What did I say? Gotcha.
Yeah, so you can check each one of those one time a year for free, and it doesn't hurt your credit. It's not a hard pull when you do it one time a year. If you do it more than that, then yes, it is a hard pull. So you get to do that one time a year. And you're not just getting it and looking at the score and being like, oh, cool, I have a 760. Done. No, you want to look down underneath what is contributing to that 760 and look to see if there's any inaccuracies. Does it show some sort of a debt that you don't remember doing? Does it show a late payment that you didn't have? If there is a mistake, you can always call up the credit bureau and dispute those things. Hey, you guys said that I missed a payment, but I've never missed a payment. Can you look into this? Oh, for sure, Dom. We just realized that we charged you for the wrong thing. It's actually not you. Cleared up. Done. Credit score just jumped 20 points.
Yeah,
but if you don't look at it, you're never going to know.
Simple as that.
And if your score is shit,
yeah,
start taking the necessary steps to figure it out and fix it. And if you need help with that, you can always go back to episode 26 of the Five Guys, where I break down everything that your credit score is, how it's calculated, and more importantly, how to improve it.
Yeah. A lot of great stuff in that episode. Very, very, very useful. Number 10, we're talking about insurance coverage. You're going to want to review all of the different policies. You get your home, your auto, life, etc. Very simple, very important too. You got to keep that stuff up to date, especially if you've moved and whatnot, stuff like that. And maybe it even could be time to compare policies. What do you think, Chris?
Yeah, I recommend doing that at least once a year. I do it twice a year, but again, I'm neurotic. Don't be me if you don't want to be me. But yeah, at least once a year, you should go ahead and try to compare coverages for your insurance, because you might be loyal to your insurance company, but that doesn't mean that your insurance company is loyal to you. Oftentimes, the best way to get savings is to switch. You switch to a different carrier who actually does want your business, because they're willing to change. And then eventually that person's going to get sick and tired of you too. And you're going to have to go ahead and try to find another person. There is no fix that's going to work forever. That's just part of life.
Yeah, exactly. Do you think it's too early for number 11? This one I'm kind of like, it's kind of interesting. If you're going to do it anytime, might as well do it now. This is number 11, tax planning. Kind of a curveball. You want to go over that one?
Yeah, of course. Okay. Whenever you work for a W-2 job, you can always get to say how much tax withholding you want to do, whether that be from, I think it's a 0 to a 6, something like that, where you get to choose how much you want. It's always good to go ahead and you can go on to smartasset.com tax calculator, put in your state and your current income, if you're married, filing singularly or jointly, and it'll give you a projection as to how much money you should be in taxes, roughly. And it's only going to be for simple. Well, from there, you can look at how much money you've already had withheld in taxes and see, okay, am I about halfway there right now? Yeah. If I am not, if I've withheld substantially more, well, now we can maybe talk to a CPA and figure out, should I continue to withhold more? Can I actually get more money? Am I just making a 0% interest loan to the government for no reason? Or it could be the opposite. Maybe I'm under taxing myself. And at the end of the year, I'm going to be left with this major tax bomb that I'm spending all my money, and I'm not going to have the money to deal with that. So many people end up in financial help. I mean, Wesley Snipes ended up in financial distress because of this kind of stuff. Because of, well, he was doing tax evasion, but because of this stuff, when it came to light that, like, hey, you weren't paying taxes, he didn't have the money to fix it, even with all of his money royalties from his movies. And he ended up going to jail for that. And you don't want to end up being inside that same situation. You don't want to end up being the person who has to take out a personal loan or a home equity line of credit, or God forbid, put payment on a credit card in order to pay off the IRS.
It's a nasty cycle. It's a nasty cycle. You can get caught in it real easy. That's why you got to pay attention. That's why the 6-month check-in is so important. And I know the podcast is all dedicated to the 6-month check-in. We understand that, but you should be checking on your finances way more than just 6 months.
Yep.
Chris recommends that, you have a money date with your spouse or your girlfriend if you live together, or if
you
don't, your parents,
do it by yourself.
Or if you're alone, do it. This is where you go over your finance. We did a whole podcast on the money date, correct? I'm not mistaken.
Yeah, I don't remember what it was. I think it was like 26 or something 26. Like that.
Yeah. But yeah, I mean, it's very important. You got to stay on top of your finances. And we're talking about checking the income, checking the expenses. And if you're kind of uncomfortable a little bit, you can always go look for a financial advisor who is a fiduciary. Would that make sense for a financial advisor role, for them to be a fiduciary?
Yeah, I mean, I always recommend working with someone who has the best interest at heart. There's a lot of, it's just difficult, man. It's really difficult, because if you're young and you don't have money, most financial advisors aren't going to help you, because most of financial advisors work off of assets under management. And if you don't have any money to manage, why are they going to waste their time? Yeah. And the people that will often help you are brokers who are trying to sell you an insurance product, because they can make money off you pretty quick by you buying this life insurance policy or this annuity or whatever else that may not be in the best interest of you. So sometimes it's difficult to find a financial coach or a financial advisor who's willing to have you pay them hourly, because it's far more work to do hourly work and it's less reward. I can bring on a client who's going to do hourly, charge him $300 an hour, and meet with him 12 times. I just made $3,000. That's 12 hours. Or I can bring on a client who has $300,000 pay that or charge them 1% of assets under management. And I just made $3,000. I only have to meet with them once a year. And that $3,000 is growing in perpetuity every single year.
That's it.
So that's where it gets very difficult with finance. So that's the reason I recommend working with a fiduciary, working with someone you trust. And if you really don't know where to go, you can always reach out to me, Chris at monzonwealth.com, and I'd be happy to send you in the right direction. Or if I'm the right person for you, help you out. Because never in the history of ever has there been more financial information out there. And even with all that financial information out there, we are more confused than we ever have been.
Especially when you have people who look smarter, might even be smarter. They might be in positions of power giving bad advice. I was watching this a couple of weeks ago. I mentioned this on the pod. It was the vice president. And she was saying that parents should get a HELOC on their house in order to pay off their students' college stuff.
Oh my God.
I was like, okay, you're a politician. No. You're not a finance guy. You're not finance. Like, it's just, I don't know. It didn't sit well with me. It didn't sit right with me. So they're over 18.
Yeah, that's
like
terrifying.
if you're gonna play for me, like if you're gonna plan for your kids' college, it doesn't start the year they go to college. If you're gonna do a Hail Mary and bail them out, well, you're gonna put yourself at risk. I have no problem with parents paying for college. Just start when they're young. Good Lord.
Yeah. Set up a financial plan, right?
Yeah.
Okay. That's crazy. So yeah, I mean, we were talking about the tax planning, right? And then this is also a really good time to also start to consider maybe doing Roth conversions or doing a Roth contribution. But I typically recommend waiting to do that. If you are going to do a contribution, do that any time of the year. Just, get the money in there. But if you're going to do a conversion, we're converting a traditional to a Roth, I recommend waiting till, usually I do it for my clients around October and November. That's when we have that discussion. Should we do it? Because I want to have as much information as I possibly can regarding what your income is going to be, so we can actually estimate for sure that this is what this is going to cost us. Because whenever you do a Roth conversion, you are going to pay more taxes now. And I want to have all the information I can so we can make an informed decision. If you tell me at the beginning of the year, hey, Chris, I project to make $100,000, and we do, okay, let's do a Roth conversion. Let's convert a bunch of money right now. And you end up making $200,000. That's going to throw you into a higher marginal tax bracket. And now that Roth conversion ended up costing us substantially more than we projected. And maybe, just maybe, it's not worth it anymore.
Yeah. And that's a weird place to be in.
Yep. And if you don't know what I'm talking about, that's when you need a CPA and a financial advisor to help you out.
Bingo. Yeah. Absolutely.
Don't try doing this shit on your own.
No, sometimes it's good to get specialized advice. Yeah, absolutely.
And what's step number 12, Dominic?
Step number 12, let me think about it. It is update your financial goals. Indeed. So yeah, you're definitely going to want to review your goals, and not just financial. I know we're a finance podcast, obviously, but it's important to review all your goals, not just finance, but making sure, like, say, if you this year, like Chris was saying, I want to make 100,000. Where are we at? Are we at the 50,000 mark? Are we at the 20,000 mark? Right? I got to last 6 months, I got to make 80K. That's tough. It's tough. So if you're not on pace with your goals, I wouldn't change your goals, but change your output, change your work, change something. You got to change something, but don't change the goal.
And this is also a good time when you're updating your goals. Like me and my wife, for our mid-year check-in, we were talking about, hey, have we traveled enough this year? And every month for the first 6 months of the year, we went to a new destination, often in a different country. So I was saying, like, yeah, I think we've traveled enough. But my wife was like, I want to continue to do more traveling. So we had to work that into the budget. How can we do more traveling? What are we willing to sacrifice now in order to travel more in the future? And maybe you're listening to this, you're like, well, traveling, I don't care about traveling. Input whatever is important to you. That is where making sure that if you are underspending in an area that is important to you, that means you're probably overspending in an area that is not.
Yeah.
If you show me your budget, I will show you what you actually care about. Not what you say or you proclaim to care about, what you actually care about.
Yeah. Yeah, it's almost like a financial autopsy, if you think about it.
It's honestly the truth.
Yeah.
And we can hide from the truth for a really long time. So that is the 12-step mid-year financial checklist. If you didn't listen to Money's podcast, please go back. We went into things much more in depth, and we talked a lot more about philosophy and the thought process behind these things, and where the way that I built myself up to be able to do these things, and the way that Dominic has been getting better at this. Only in the past, I don't know however long we've been doing this podcast. So again, it takes time, it takes effort, and it takes consistent effort. There is no quick fixes.
Absolutely.
Please go ahead. If you are listening to this, the action step for the week was start at step 1. Figure out your spending. If you don't have a spending tracker, get a spending tracker. You go to Monarch Money, you can go to Copilot. Those cost something. You can go to Rocket Money. Not my favorite, but it is what it is. You can still do it for free, or you can just create a spreadsheet. Start writing it down with a pen and paper. It's really hard to figure out where I'm going financially or what I'm doing financially if we have no idea where our money's going. If I asked you, hey, how much money do you spend a month in gas? And you tell me, probably like $50, I know that you're wrong. If you tell me that something costs you something that ends in a 0, I know that you're estimating. And if you're estimating, you are more likely than not underestimating greatly. So real information is what we need here. This is your financial future. This is your life. This is not something to just be like, I don't know, I think it's this.
Yeah, absolutely. Hope you guys enjoyed that. We're not at the end, not even close. Now we are going into our viewer mailbag, something we do on the 5 Friday, a little 5 feedback. So that being said, it's my turn. Let me lock in. My cautionary tale. How did I end up with $200,000 in credit card debt? And here's what I learned along the way. There we go. Alrighty. Howdy, Fi guys. I landed $200,000 in the hole. Howdy, Fi guys. I never thought I'd be here sharing my story about how I ended up with $200,000 in credit card debt. But hopefully my tale can serve as a warning to others because of the dangers and the irrational spending. Wow. So that's okay. So it's irrational spending. I was wondering, 200,000 on credit. That's a lot. Like I was trying to figure out how does that happen? It's like a house.
That's not a very good house. I guess it depends what part of the country you're in.
Dude,
somewhere.
You give me 200,000 and a flight to Thailand, I'm basically an emperor. I can live good.
But I guess to be fair, we live in Phoenix now, where the average median starter home is $500,000, and then I'm originally from California, where average median starter home was $10 if you're lucky, or you can choose whatever shed at Home Depot you want.
Yeah, beach is looking good. I wouldn't mind living on the beach. I'm currently 30 years old, and I'm trying to pay off all the mess that I have created in the past. It all started innocently enough. I got my first credit card when I was about 19 and a simple $500 limit for emergencies. But the thrill of swiping that piece of plastic quickly became an addiction. By the time I was 22, I had 5 credit cards and $10,000 in debt.
Okay, so he put himself into $10,000 of debt in 3 years.
Yeah, he's doing a credit score tank speed run. I like that.
And now he's 30, so it sounds like he just kept it going,
running it up.
Yeah, I'm getting better every year. I'm learning how to make more money.
The points though would go crazy,
bro. There is no amount of points that's worth 200.
Is there a challenge, bro?
Is that a challenge, bro?
Do it. Then I got really into e-commerce and thought I was going to be the next millionaire through dropshipping. I had no business, no knowledge, and spent many thousands of dollars on courses that I thought would help me out. I was really just irrationally spending money on ads and inventory and etc. without even making any sales. How silly.
Wait, Dominic, didn't you do e-commerce stuff, or is this
no comment? No comment. I did. I gave it a good old college try. Not for me. I did like building the website though. That was fun.
Okay.
By 26 or about 27, I convinced myself that I needed to be living a luxurious lifestyle that would somehow teach me about wealth. I lost track of my due dates, missed my payments, and watched my credit score take a free fall. Desperation led to even more reckless decisions, and I ended up taking out cash advances to cover other bills, ignoring the astronomically high fees on said action. Don't want to pull cash on a card. Please don't.
Yeah, go for it. One thing I was thinking that what he said there is like, where did he put it? I needed to live a luxurious lifestyle and hope that it would somehow teach me about wealth. So his thought process was, in order for me to be wealthy, I have to live like a wealthy person, and then I'm just going to manifest it into existence because I deserve it. I'm going to get mine.
It's not how
And look where that led
manifesting
him.
works. No, not it at all, buddy. But the story has a good ending, I'm hoping. My most irrational purchase was buying a $17,000 watch. I immediately recant my statement previously. On a $35,000 a year salary.
So he was only making $35,000 and he put himself into $200,000 debt. He must have been trying really hard to open up a lot of credit cards. He probably has more credit cards than I do.
Probably. With a higher limit?
I doubt that.
I doubt it. Yeah, you got like unlimited limits. I now have a, okay, sorry. I saw the sentence coming up and I thought it said, I now have a 22 credit score. And I'm like, what? 22? What kind of Taiwanese crap is this? Ain't no such thing as 22. It only goes down to like what, 400 or something like that?
Yeah, you have to try.
Yeah, you gotta try. I now have 22 credit cards and I'm still trying to get myself out of this situation.
Okay, so he has more credit cards than I do.
He does have more. You have 16, don't you?
Yeah. Something like that.
Something like that. Moral of the story is be careful with debt, guys. I've been listening to your podcast and wanted to thank you for all the knowledge that you have given me this far. I know that getting myself out of this will be very difficult and a long road ahead, but I know I can make it through this rough time and I will learn from my experience. Thank you so much for your support and sharing this experience to others so that they don't end up in the same place. Cash advances, reckless chances. Please learn from my life's closing dances. Okay.
Costly dances.
Costly. Yeah. You work on the money side, I'll work on the English side. Good Lord. Anyway, so that's kind of wild. That takes guts. That takes guts to put it out there.
To admit it to yourself. Yeah. So thank you so much. Cash advances, reckless chances. Please learn from my life's costly dances. That's clearly his name. That's really brave of you to come out here and just try to share with the listeners so that they don't end up in the same situation. Mm-hmm. And I think it's really easy for other people to listen to this story and be like, how stupid. Like, how dumb is this guy to do that? I would never do that.
Yeah. It's easier than you think.
You're out there doing something very similar, and we're never aware of what our blind spots are. That's why they're called blind spots. We don't know what they are. Sometimes it takes somebody else who's trained to actually see it. And then more importantly, not just see it and tell you about it, but get you to see it, get you to realize that there's a mistake here, that there's a problem before you end up in a bad situation. One thing that I like about Five Friday feedback is typically the person asks questions, what do I do? I think based off of this person listening to the podcast, they know what they have to do. And they know what I'm going to say. They know I'm going to say, you're going to have to freaking create a budget. You have to start trying to make more money. You have to start spending less money. And then you have to just throw it at the debt as fast as you can. We have 22 credit cards with $200,000. Even if we were to consolidate all of that, typically there's a 3 to 4% consolidation. That's going to cost you a pretty good amount of money just to consolidate them. And then if you don't pay off the $200,000 of debt in typically 6 months to 18 months, depending on that 0% interest, well, now it's going to retrograde all of the debt that you didn't pay back. I don't know what this guy's current income is anymore, or what this guy's current income is.
Well, you said $35,000.
We said it was $35,000.
It was, okay.
He said that was my most irrational purchase. I don't know if that still is.
True.
But if you're really at $35,000 salary with a $200,000 credit card debt, average APR in a credit card is anywhere from 15 to 25%. Remember the rule of 72. Any amount of money divided by, or whatever you compound your money at divided by 72 is what it takes to double. So if you have, let's just go 25% interest rate, 72 divided by 25 is basically 3. Every 3 years, your debt will double. Making minimum payments is never going to get you where you want to go if you're only making $35,000. Don't suggest bankruptcy lightly. Please go back and listen to our bankruptcy one if you think that it is just something that you do for funsies. That's episode 32 of the Five Guys. It is not. But in this circumstance, $200,000 in debt, if you're only making $35,000 a year, I don't know how the hustle is going to get you out of it.
You're gonna have to get a much better paying job.
Yep.
Something in the $70,000 to $80,000 range would be nice. Good start.
Yep.
Very
There's no choice. No choice but that. But to
increase
make more
money, decrease spending. And do not use a credit card anymore. You're done.
Yeah,
You're done.
You
buddy.
don't deserve it. Yeah. You can get it back. You can get it back later. But right now, it's gone for you.
It's done. Yeah. I wouldn't. I would clear them out. I'd have maybe one credit card. 5,000 limit.
Just 500 limit.
500, even better. 500.
Yeah.
I'm just thinking for like a hotel though. You can't. It's like.
How's a hotel emergency?
What? Well, no. I mean, like, that's what I'm saying. Like maybe like $2,000 card limit. Well, like have one credit card. That way you can put a hotel on the credit card, because you have to have a credit card to go for the hotel.
Bro, you're trying to pay off $200,000 in debt.
I know. I'm thinking that a little bit. Maybe I'm too far out. My bad. I'll reel it back in. Anyway, best of luck.
Best of luck.
Cannot
Thank
wait
you for sharing.
Maybe a year or two, a couple years down the line, reach back out, see if you got it. See if you locked in, killed the 200,000. What's crazy about that is, like, we talked about earlier in the podcast. It might have been Monday's pod, but if he can cut the $200,000 of debt, let's say it takes him 5 years, right? 5 years. He can also say he didn't have any debt. Say he had no debt. You could also save the $200,000. You know what I'm saying? How, like, money is different, but it's the same at the same time. It's like the analogy you used earlier with I think it was the mother of, you could either pay this way or not spend it, something like that. I'm just thinking like, dang, dude. But if he gets that hustle muscle and really gets a better job and all this different other stuff, I don't know. Maybe I'm rambling.
I think one of the best things and there's not a lot of good things that putting yourself into debt does. I'm not going to lie to you. It's bad. But we try to look at the positives because it's all that we can do. In this situation, if he learns to really buckle down, really live off of less money than he's making for a number of years to pay off that debt, once he pays off that debt, if he continues to live that lifestyle, that Spartan lifestyle, and instead of putting that money at the debt, now he gets to put it at investments. Well, now he has the twofer. Now he has more money going towards investment, and he's lowered his lifestyle cost, which means he now needs less money in investments to get to financial independence. So is this going to be a hard road? Yes. And is there anything that a financial advisor, a financial coach, anything can do to make this easier? No. I think a lot of people, they'll get upset with financial advisors because they'll come to them with this kind of a problem. I'm $200,000 in debt. I make $35,000. Fix it. And the advisor goes, I can't fix it. And then the person goes, well, fuck you then. You don't do anything. I'm gonna flip the table and go to Google and say that you're terrible at your job. Because at the end of the day, they're looking for a hero to save them.
Yeah.
And there is no hero to come to save you. The advisors that get in trouble are the advisors that promise their clients that they are the hero, that they are the hero, they are the messiah, they are the person. You are the hero of your own story.
Yep. Well, with that being said, good luck. And we're going to move on to win of the week. So I think I'm going to go first on my win of the week. My win of the week is that I will be leaving tomorrow and I'll be going on vacation. I'll be going to the great state of Texas. And hopefully I can get some barbecue in me. And it's going to be a great trip.
I just got back from Texas. It was fun.
I'm going to go visit your friends.
Visit my friends in Texas.
Yeah, I'm going to go visit them and be like, Chris was here, wasn't he? Oh, yeah. But yeah, that's my win of the week. Very excited about that. So, yeah. Chris, what do you got?
Nice. Well, enjoy your time out there. So I am currently working on creating a private money coaching arm of my business. And it's showing a lot of promise. So like we talked about earlier on the pod, unfortunately, young people today, retirement used to be a three-legged stool in that there was Social Security, there was pension, and there was your savings. Pensions are all but gone. Maybe there's like 2 jobs that offer pensions. Social Security for people our age will be dramatically cut by the time you get there. I truthfully believe that there's a lot of overhype as to that there will be no Social Security. I think that whatever you estimate your Social Security to be at, cut it by 30 to 45%. So you're going to be getting, let's call it 35% of what you should be getting by the time we reach that. But that still only leaves a 2-legged stool: your savings and 35% of the Social Security, or not 35%, 65% of the Social Security that you should have been getting.
Yeah. Yeah. Yep.
And most financial advisors only work with people under an assets under management policy, meaning that you have to have money to get financial help. And I don't think that that's very fair for people, because if you were to come to me, Dom, and you said, Chris, I need your help financially, I would say, how much money do you have in investments? And you would say, oh, well, I'm just getting started. And I would say, well, I'm not going to help you, man, because there's nothing in it for me. So I'm starting a private money coaching where I will not be acting as a financial advisor, but as a financial coach. And there is a little bit of a nuance and difference in there in order from a compliance standpoint, but it's really helping people deal with their money psychology, deal with their philosophy. And this is a place that I'm uniquely positioned for, to merge the finance with the philosophy, with the psychology, and really get people on a much better path than they ever would be. Rather than focusing on the 10 to 20% that most advisors do, where they only focus on the investments, only focus on this. Give me all your investments and I will be your hero. I'm trying to sell people on I'm going to focus on the other 80 to 90%, the more important part. But I'm not your hero. I'm just your guide. And this is why it's so hard for this business to maybe get off the ground, is because at the end of the day, I'm not selling somebody something quick fix.
No.
I'm selling you hard work, dedication, and responsibility. Those are three things that you're always in control of. But I understand that it's not sexy and it's not a good sales poster. So that is the change that I'm trying to be in the world, to help people that were me, that are my parents, that are millions of people in the world right now who need help, but aren't getting it from traditional financial advice. So if that's something that interests you, you can always reach out to me, chris@monsonwealth.com. We can go on a private coaching call, see if we're a good fit. And if so, we can talk about pricing and moving into the private client relationship where we can see what I can do to help you. And that might be dealing with your money psychology, answering your questions, or just teaching you stuff and applying what we generally teach here on the Fi Guys to your specific situation to help you get to wherever you want to go. Because
Absolutely.
I think a lot of people that go to financial advisors and say, hey, get me to my destination. It's the same thing of jumping inside your car and telling Google, hey, Google, take me somewhere. In order for me to make you a plan, I need to know where you're going. And I think that all the information that I'm ever going to give you is going to be in these podcasts. But that means that it's on you to go back through the back catalog of every single podcast we've ever done, listen to my words, internalize them, and then apply them to yourself. Or you can go the easier way and come with me directly, ask the questions, and I will apply it to your life for you.
Yeah, absolutely. Absolutely. Well, with that being said, good luck to you, Chris, in your new venture.
Yeah.
Do we have an action step, or is it the same as last week?
It was the same action steps. Start the mid-year financial checklist. We already talked about that before we moved on to win of the week.
Well, with that being said, I guess we'll see you guys on Monday. You guys have a great weekend. Happy 4th of July if you are watching this on 4th of July. Which actually would be impossible because it's not going to come out during 4th of July. Forget I said it. Have a happy July.
Happy July indeed. It is difficult to record a week before we actually drop it, but that is how we stay ahead. Okay. And with that, please tell a friend about the Fi Guys. If you found interest today, bring a friend along for this journey. Please like, subscribe, leave a comment. Tell the algorithm that you like us. And until then, later.
This video podcast is sponsored by Monson Wealth. The content in this podcast is for informational purposes only and should not be considered financial advice. We do not endorse specific products or services. Past performance does not guarantee future results. The opinions expressed are those of the host and guests, not the podcast sponsor.
It is crucial to consult with a qualified financial advisor or professional who can provide advice tailored to your specific needs before making any financial decisions, investments, or taking any other actions. If you are seeking specified help, you can reach out to Chris at monsonwealth.com.